Just like to welcome everyone this afternoon. We are going to have people that are going to continue to pop on, but I'd like to thank Jeremy Morris, CPA, member owner with Williams Keepers, LLC. Jeremy, I appreciate, again, asking you to come on and educate our members on the Payroll Protection Program and the Flexibility Act now had just been passed. A few weeks back. And so we're just going to let you roll through. I know there's been some changes, some updates, and they continue to roll out as you had indicated. But what will allow you to go through it and again, educate our members and non-members. What we would like to do, folks, is hopefully everybody's been on a chat or a Zoom meeting before, is if you would like to, if you have a question for Jeremy, just put it in the chat box, and Jeremy and I will follow along with that as we go. But, you know, please, we want this to be interactive. So please, if you would, use the chat box. So with that, Jeremy, I'm just going to turn it over to you. And again, thank you very much.
No, I appreciate the opportunity. Yeah, I don't think we're actually going to get any questions because I do believe Treasury Secretary Mnuchin at one point said every unanswered question, everything has been answered up to this point. I think that was about a month ago. So I don't even know why we're discussing this, somewhat tongue in cheek, sorry. But no, I appreciate the opportunity. You know, I think we were last with you almost 2 months ago exactly, whenever the CARES Act had been out for a little bit. The Families First Act kind of did an overall presentation on this, on all of that aid, and PPP was a part of it. And again, I think it was 2 months ago. It probably feels like about 2 years ago. As Sean has said, there's been a lot of additional guidance, you know, that continues to be issued in addition to this bill that we'll be discussing today, which, you know, greatly, you know, modifies, you know, and does what it says it's going to do, is add flexibility related to the Payroll Protection Act, the Paycheck Protection Program, and the forgiveness piece of that. So to that point, you know, we got new guidance within the last 2 hours. And again, thankfully, it didn't drastically change anything in this presentation, but there is something that, you know, there are some items that it does have a change to. So I will make mention of that as we go. So let me, again, hoping technology works. And to that point as well, while I mess with this, I believe Sean is recording this, but I do apologize in advance because this will likely be old and cold within 10 hours of me giving this presentation. There will likely be some type of guidance that's issued in the meantime that'll, you know, make some significant portion of this obsolete. So, which tends to be the nature of how things are going. So let me get the PowerPoint presentation up. Sean, let me know if you see that.
I see it.
All right. I will go ahead and shut my video off. Okay, so really what we thought we would do maybe to start this off is to start with, you know, how we got here. So again, Paycheck Protection Program is what we're talking about, and more specifically, this Flexibility Act. So we've put a timeline on here, kind of a sort of background and context as to why we're talking about this today, what it is that's causing us to have to go back and look at new legislation related to this program that's been around since March, which again seems like a lifetime ago. So, you know, all of this is in response to the coronavirus pandemic, and this was a piece of a larger aid package. And all of that, though, was prompted by, you know, the concerns in mid-March related to the spread of the pandemic and how communities could responsibly respond to that. And you know, the federal government and state and local governments obviously realizing there would be economic consequences to doing that. And so how to mitigate those negative consequences associated with it. So, you know, we go from March 13th, that's whenever the state of emergency was declared in Missouri. Boone County issued their stay-at-home order on the 25th. Us in Cole County, you know, we got the stay-at-home order on the 28th. And then between the two of those, we got the CARES Act signed into law. And that was a general business business relief act related to COVID. And part of it probably the piece that got the most play in the popular press was related to the Payroll Protection Program, or Paycheck Protection Program, or the PPP as it's referred to. And so once that happened, again, there was a lot of discussion related to this. Again, you know, the communication from those in government was, this will provide funds to provide you in your business the confidence with which to continue on, not knowing what the future would hold in the short term or even in the long term. So there was a pretty quick turnaround on this. And again, I like to joke about all of the guidance, you know, and about how quickly some of this stuff becomes obsolete, but we don't want to lose sight of the fact that this was a pretty significant bill that they implemented in a relatively short order. As we can see, by April 3rd, SBA began accepting applications. That's for what I would call traditional businesses, non-self-employed individuals, think businesses with employees. And then a week later, on April 10th, the SBA began accepting applications for self-employed individuals. Now, the funny thing is we knew the money wouldn't last long. We just didn't know how long not last long really meant. And we got the answer to that. So April 16th, the first bucket or the first round of funding is emptied. So within 2 weeks of the program being rolled out, and then less than a week after our poor self-employed individuals got a crack at it, the PPP program and the SBA ran out of their first almost $350 billion worth of funding. And so that was that, until again, the feds and Congress decided, look, there has to be more money. A lot of businesses didn't get to the trough, so to speak. There's still a lot of need. It didn't look like things were going to end anytime soon. So Congress passed, President Trump signed on April 24th, an additional $310 billion of funding, which then opened this program up significantly. And we're still going through that money. That, as we sit here today on June 23rd, there's still funding associated with this. And again, there may be some reasons for that. You know, I think those with the most need probably got it. I think there was a lot of confusion related to the rules. I think that for those individuals maybe that wouldn't be getting larger loans, it's maybe kept them away. There was a period of time where, I'll just be completely honest with you, you guys, if those of you who have the loans, remember this, where, you know, SBA and the federal government put a lot of doubt in a lot of people's minds as to whether they and their business could certify that they got these funds, that they received these funds and applied for these funds in good faith. And we've now since moved past that, where I think individuals have a lot more confidence with it. But I think that too has slowed down this process. But needless to say, as we sit here today, we still have PPP funding available, and there are a lot of individuals in our communities, you know, that we serve, Jefferson City, Columbia, you know, state of Missouri in general and beyond, that have accessed this program. And through that time, we've had to deal with, okay, so it's getting individuals into the program. That was the first hurdle. How can we help people do that? And now the issue is okay, you know, everyone you have your loan, you're doing your best to track cost. There's a lot of strings in some instances attached to this. What do we need to do to get forgiveness? That's really where things have moved. And so that's what we want to talk about. And so to that point, so my point about the guidance, you know, beginning on April 2nd, again, within, you know, we began getting guidance associated with this related to the application process. And then all the way through June 5th, I counted 16 what they call interim final rules that add guidance to the PPP, both as it relates to the application process and now as it relates to forgiveness. And that number is actually light. Again, we cut it off at June 5th, but since then we've received, I believe, 2 more additional rulings, one of which was released within the last couple of hours. And so again, you guys are getting, you know, literally the latest associated with this. And again, I would expect more guidance forthcoming. So that sets a stage for sort of where we are today. All of you guys know what this is. This was part of the presentation we gave in April. No need to go into this in great detail, but you know, for those of you that have these loans, as you recall, this was related to payroll. The loan amount was related to payroll. It was based upon 2.5 times your average annual salary for average monthly salary for 2019. And then as long as you spend them on what we have termed internally as good cost, payroll, mortgage interest, rent, and utilities over what was originally an 8-week covered period is what they referred to it as, you can get full forgiveness or you can get forgiveness on this loan. Where the complexity comes in, and again, is why we are talking about this and why there was a need for a Flexibility Act, is there are sort of strings attached related to this. The whole concept of this is they wanted to provide assurance to businesses and get money out get capital out into the economy as quickly as possible. But they wanted to encourage businesses to continue to employ people, even in situations where maybe it was uncomfortable to do so. And otherwise businesses would have had difficulty doing it. So forgiveness can be in some instances scaled back if you don't meet certain requirements. And this is where all of the complexity comes in. So if you have a greater than 25% reduction in non-highly compensated employees' salaries or hourly wages when compared to Q1 of 2020, when you're looking at the 8-week period, and you will lose some of your forgiveness based upon that reduction in wages or compensation. And by highly compensated, it's anyone who at any point during 2019, during any pay period, you're deemed to be highly compensated if during any one of those periods, your annualized income would have been over $100,000. And so that's the baseline for that. In addition, if you reduce your FTEs, your full-time equivalent employee count during that 8-week period, there will be a pro rata reduction in your forgiveness. So those are the two biggies in the act. And then in addition to that, and this one caused a lot of heartburn, was that this wasn't in the act, but via regulation, SBA and Treasury said, in addition to that, to help us allocate these funds, we want them to go to businesses that have payroll. You must use at least 75% of 75% of your forgiveness has to be related to payroll cost. And this caused, again, a lot of heartburn because, and it's probably one of the more misunderstood sections, because in a lot of times in the popular press, this was portrayed as a cliff. So in other words, if your business does not use 75% of the loan amount on payroll related costs, there was some concern with individuals that there was no forgiveness at all. And that's not the case. It just relates to a reduction in your forgiveness. So what it does is if your non-payroll expenses are too high, it limits the amount of those non-payroll expenses that are eligible for forgiveness so that you fit within a 75-25 situation. So as we've gone through this, we being Williams Keepers, this is how it's really a 7-step process that we've looked at related to how to maximize forgiveness. First and foremost, you have to spend the money on those good costs. Within that, then you have to be concerned about, are you paying your people enough? You know, again, have you had a more than 25% reduction in wages for any employee? And you look at that on an employee by employee basis. Are you paying the right number of people? In other words, have you maintained your employment levels from your baseline period, which you get multiple options for that. But generally, your baseline would be either beginning of 2020 or early in 2019. If you don't, however, and I kind of skimmed past this on the last slide, the issue with these what I call the haircuts is that, okay, so if you spend the money on good costs, but let's say you don't pay people enough or you don't pay the right number of people, there's an escape hatch or an escape clause related to this where you can be forgiven and those reductions in salaries and wages will be ignored for purposes of forgiveness limitation if you fix the problem within a set period of time. And we'll talk about that here in a second. So once you do all of that, then you have to consider, okay, what's the level of my non-payroll good cost to my payroll good cost? Make sure it fits within the 75-25 dichotomy. And then you put it all together and that produces your forgiveness amount. And then you have to do the application. And so that's the step. But as we were going through this, again, it became clear that for a lot of businesses, it was going to be difficult. You know, we talk about maximizing forgiveness. There were difficulties in businesses being able to maximize their forgiveness. And the reason for that was really how this thing was structured because of the fact, you know, you hear people talk about, you know, they were building the plane as they were flying it. And that's kind of what happened here. And so it was sort of if you think back to that timeline, sort of a perfect storm of events that caused this program for a lot of businesses to not necessarily be as beneficial as what it should be. So what happened was everybody knew that that $350 billion was not going to last long. Again, we started working with clients early on, and we were looking at our client base and the amount of need within our client base, and you can kind of start doing the math, and you realize, I don't, that this thing's not going to last forever. And again, it lasted less than, 2 weeks. And I think some people were even surprised it lasted that long. So because of that, everybody was rushing to get their applications filed so that they got to be at the front of the line, first one to the trough, so to speak. The problem with that, though, was that in order to really maximize the benefit from this, because of the reduction, the issues with the reduction in FTEs and the reduction in wages, it would have been nice if businesses had had the opportunity to determine when the funding occurred. The problem was after everybody did the applications, they got approved for the applications, SBA dictated that those loans then had to be funded within 10 days of loan approval. And the issue with that is, so you didn't have the ability to push this date off as to when you receive the funding. And the funding date is important, not only because obviously that's when your business receives the money, but because that starts the 8-week clock under the CARES Act as far as when you can begin counting expenses. So because of that, though, think back to that timeline we talked about. Stay-at-home orders were issued, 25th of March in Boone County, 28th of March in Cole County. Businesses couldn't get to this until April, early April. You got in early, you received the funding within 10 days of getting your application approved. But a lot of businesses, again, particularly depending on what industry you were in, were fully or partially shut down at that point, which makes it difficult to get forgiveness because, one, if you're not in business, you're either forced to decide, okay, do I just pay people to stay home? And again, we've had a lot of discussions with our client bases individually and in larger presentations kind of dealing with this is, what's the optimal solution in that situation? Do I allow my people to go on unemployment and then bring them back and hope I can still fill the, the PPP bucket, so to speak, with good cost during the 8 weeks? And so bottom line is, it's either you're paying people, even if there's no income coming in, with these funds, or your people are already home, on unemployment. That reduces your wage base. So again, fewer good costs to pay. In addition to that, it's also going to make it more likely that you've had a reduction in FTEs, which is going to lead to a reduction in your forgiveness as well. In addition to that, there were some businesses that maybe had a higher percentage, of non-payroll costs, or maybe put another way is even if you had a reduction in salaries and you were paying rent and utilities and what have you, those other non-payroll good costs, this 75% rule that was added after the fact by SBA limited your ability to get forgiveness related to those non-payroll costs to the extent your payroll costs were limited. So the smaller, the lesser amount of payroll costs that you could count towards forgiveness, in turn, that reduced the amount of non-payroll costs you could count. And in addition to that, as we just talked about, again, as we saw guidance again issued within the last 2 hours and 20 minutes, guidance was also being regularly issued throughout this process, which made people were tending to behave in ways based upon the most recent guidance they had, and then having to adjust on the fly as new guidance was provided that may cause you to change your decision point. In other words, for example, do we need to pay bonuses now? What about this situation? What about that situation? Can I fund my retirement during the 8 weeks and have all of it count? Again, and so businesses were kind of holding, trying to do the best they could, but in some circumstances, payroll costs were limited. They were trying to just react based upon the guidance. And so for a lot of businesses, they would have had difficulty meeting the total forgiveness within the 8-week period. So that's then what prompted what we're talking about here today, which is the Paycheck Protection Program, or PPP Flexibility Act, which was signed into law on June 5th. And so what that did, we're going to talk about the big pieces of this, but the major components, and the first one that we're going to talk about relates to the period of time. Because again, that we're talking 8 weeks. For most businesses, that clock started middle to say late April. And that was still in the middle of this, of all of these stay-at-home orders related to the pandemic. So, Congress thought if we can extend the period of time, that will make it more likely that we can get forgiveness. And so the first major change associated with this was a change in what I've referred to as the covered period, and that's what they refer to it as. So we've shown here the difference between the two. So under the old rules, basically you got payroll cost paid within the 8-week period, starting on the day the loan is first funded, or payroll costs that were incurred but not paid during the 8 weeks, assuming they were accrued and incurred during the 8 weeks and paid on the next regular pay date. And that was one of the big, still is a source of confusion, but that was something that paid or incurred was something that came out in guidance. And that added some flexibility related to this. But again, for most businesses, it still didn't do the trick. And so, in other words, if you've got payroll cost on the front end of your 8 weeks that you paid, even if they relate to a period before the 8 weeks, you get to count them. If you have payroll costs you incurred at the end of the 8 weeks, but you don't pay them within the 8 weeks, that's okay, so long as they get paid on your next normal payroll cycle. Again, borrower and business friendly is how that worked. So in theory, you could get and accumulate more than 8 weeks worth of payroll cost, for example, towards forgiveness. But still, for a lot of businesses, that didn't fully do the trick. And so under the Flexibility Act, the default is payroll cost actually paid or incurred. We still get the same thing, even though they've given us a longer period of time. We still get that same paid or incurred, but we get it within a 24-week period of time versus the 8-week. So same thing. Any payroll cost you pay in the 24 weeks or any payroll costs that are incurred before the end of the 24 weeks, you get a count, assuming you pay them on the next regular pay date after the end of that period of time. So that's what I would consider to be normal payroll. Now, because of that, though, they also don't want, we talked about highly compensated. For any individual employee, you can only count their compensation up to an amount of $100,000 on an annualized basis. So under the old rules, what that meant was that for any given person, no matter what that number came up to be, so paid or incurred during the 8 weeks, you accumulate that on an employee by employee basis, but under no circumstances could that amount for purposes of forgiveness exceed $15,385 under the 8 weeks, which is $100,000 of annual comp divided by 52 weeks and multiplied by 8. They have kept that in the new bill. So again, for your run of the mill, maybe not run of the mill, but non-owner employee. Well, really, for your non-owner employee, that cash compensation portion of payroll cost is limited to the 24-week equivalent of $100,000 or $46,154. So for any employee during the 24 weeks, if that's what you choose, you can't count more than $46,000 of payroll cost associated with them. Now, if you have owner employees, there is an additional limitation. And again, this is also one of those rules that was not in the CARES Act, but was added by regulation. And so what they didn't want people doing is they didn't want business owners, say, laying off employees and increasing, maybe they didn't draw the full 100,000, increasing their compensation up to the 100,000 to meet the forgiveness requirement, okay? So in addition to those limitations we talked about before, the $15,385 or the $46,154, depending on what period of time we're talking about, under no circumstances can the amount you count of an owner employee's compensation exceed either the 8-week equivalent of 2019 compensation, and that would be under the old rule. So again, whatever your compensation was in 2019, if it was less than $100,000 as an owner employee, that's your limit. Take that amount, multiply it by 8 divided by 52, that's your limit. So lesser of $15,385 or 8/52 of 2019 comp. That got changed in the new rule, but they didn't go all the way to the 24 weeks. And so that amount is actually for an owner employee, it's capped at either the lesser of, it's $20,833, which is only 2.5 months worth of $100,000, not 24 weeks divided by 52, but 2.5 divided by 12, or the equivalent 2.5 months worth of 2019 compensation. And the reason they did this was because that was the amount that you got the loan based on. If you recall, the original loan was based upon 2.5 times compensation. Because of the reasons I stated, they didn't want owners, given the fact you've got 24 weeks, now an owner could use more of their compensation than what they received in loans, and they could use that to make up for, say, deficiencies by laying somebody off, a non-owner employee. So where Treasury and SBA came down on this and said, look, you got the loan amount based upon 2.5 months of your 2019 compensation. The maximum forgiveness we will give you as an owner employee is also limited to 2.5 months of 2019 compensation, so that you can't game the system. They don't want windfalls to owner employees because of this act. They want you using the money to pay employees. So same thing with self-employed individuals. If we had a self-employed individual, they got an income replacement, which under the old rules, the loan was calculated at 2.5 times of 2019 self-employment income, on a Schedule C or on a Schedule F. And the forgiveness is based upon 8/52 of that same 2019 income. And in neither case can that exceed, the equivalent of $100,000 or $15,385. So for those individuals under the 8 weeks, you got the 8-week equivalent of your 2019 self-employment income. As it is under the Flexibility Act, you get 2.5 months worth of your 2019 income. So in that case, if you were a self-employed individual and you had $100,000 worth of self-employed income in 2019, self-employment income on a Schedule C, your loan amount should have been $20,833, which is 2.5 months worth of that $100,000 of income. Your forgiveness amount is that exact same amount. It's just a strict mechanical calculation. Your 2020 activity does not matter if you are a self-employed individual. It's calculated based upon the same 2019 business income. Again, self-employment income on a Schedule C or a Schedule F. So that's the payroll piece of it. We get an equivalent for non-payroll cost. So again, under the old rules, those non-payroll costs, rent, utilities, mortgage interest, you got to include anything paid within the 8 weeks and anything incurred during the 8 weeks but paid in your first bill on your first invoice after the end of the 8 weeks. They've kept that same concept but have now extended it out to 24 weeks. So that is the largest change in this bill, is that what was under the old 8-week system is now, generally speaking, a 24-week period of time to fill the bucket. Again, the amount of the loan is fixed, and the amount of loan was based upon 2.5 times 2019 wages. So for a lot of businesses, even those that were shut down, as businesses begin to open up, there's enough time within that 24-week period still where we're going to see more people being able to fill the bucket with good cost. Again, that first step that we talked about, spend all of the loan proceeds on good cost. So related to this then, the default has now become a 24-week period. But, in no case though, because again, these loans can now be made up through the end of the year, whereas previously, June 30th was the final date on that. The final period to make one of these, or the period to make these PPP loans, ends on December 31st, 2020. So we get under this act a maximum 24-week period of time, or December 31st, 2020, to count our good cost, whichever one of those comes first. Now, for those businesses though that applied, before the Paycheck Protection Flexibility Act was passed. So anyone that had PPP loan proceeds that they received before June 5th, they can, if at their election, decide to use an 8-week period versus a 24-week period of time. And we got a little bit of guidance that again, just within the last 2.5 hours, that put a little bit of a wrinkle in this, but not much. And we'll talk about situations, why you would do that. Well, the next step on this, next box in gold, the reason you would want to do this, the reason is if you can fill the bucket, so to speak, with good cost within 8 weeks and get full forgiveness, and you've not had a reduction in FTEs, you've not had to reduce anyone's salary or hourly wage, you think you're going to get full forgiveness after the 8 weeks, the recommendation would be to apply based upon 8 weeks and lock in that full forgiveness now. There's no benefit to waiting until the end of 24 weeks. One, it's going to delay the application process. And two, you run the risk that what happens if in weeks, 19, in the next 16 weeks, from week 19 to week 24, you have to have a reduction in FTEs, COVID related or not, or you have to reduce salaries and wages. Well, now because you've waited for the 24 weeks, you've potentially, and I say potentially because I think we got some relief for this, you've potentially opened yourself up to now not getting full forgiveness under this act. So that would be a reason why we would, businesses, if you think you're going to get full forgiveness after the 8 weeks, go ahead and apply using the 8-week calculations. The good news is we don't have to make this decision up front. We get the benefit of hindsight. We can go through the end of the 24 weeks, crunch the numbers both ways and say, okay, well, we wouldn't receive full forgiveness after the 24 because we had to have some FTE reduction. We had to let some people go or reduce hours. So we're going to choose the 8 weeks. Or maybe the 8 weeks didn't give us full forgiveness, but when we stretch it out to the 24, we get full forgiveness. Okay, at the time we do the application, we're going to choose 24 weeks. So again, we get the benefit of hindsight associated with that. However, if you have a business that is staring at the end of the 8-week period as we sit here today, and you have not reduced employees or hours, you've not reduced wages, and you are going to pay all of your PPP loan in good cost, you're going to pay all of the appropriate expenses within the 8 weeks, or let's say you've paid as many expenses as you can, and you're really close to hitting your full forgiveness amount, but you're not quite there. Because of the concern about having to track FTEs, and wages after the 8 weeks, some businesses may want to give consideration to doing something before the end of that 8 weeks. For example, paying a bonus, whether it's hazard pay or just a bonus for sticking with us. You may want to do that to fill the bucket if you're close to the end of if you're close to paying all of your expenses in good cost before the end of the 8 weeks and you're not quite there, and you think you'll get full forgiveness if you just pay a few additional expenses, you may give consideration to doing that. Now, again, I think there was some guidance that we got, again, within the last couple of hours that may make that a little less urgent, but that's definitely one way to assure yourself that you're going to lock in full forgiveness if you're close. If you're close but not quite there, you may want to take some action before the 8-week period ends to maximize forgiveness now, to not mess with the 24 weeks. So that's related to, if you think back to that step 1 that I mentioned, pay good cost, that greatly impacts that. So that's what this is. We now have a longer period of time to pay those good costs that are eligible for forgiveness. But what happens if we had to let people go, we had to reduce hours, or we had to reduce compensation? Well, as I mentioned, that would cause a reduction in the forgiveness amount, but there was a way to get around that. Okay? There were a couple of ways, one of which was through what they refer to now as exceptions to FTE reductions. In other words, think of this as, yes, you had a reduction in FTEs, you don't have as many employees working as many hours as what you did before, but we're going to act like you did. We're not, in some circumstances, we're going to allow you to count people that are no longer working for you. And here's what the exception was under the old rule. If you had somebody that you either laid off or reduced their hours, during the 8-week period of time, which is what the old rule was, if you made a good faith written offer to either rehire them or restore their reduced hours at the same salary or wages as in the last pay period prior to you letting them go or reducing their hours, and the employee rejected that offer, and the business maintained all the proper records and notified the state unemployment office within the proper period of time, if you did that, you got to count that employee as an FTE. So again, you laid them off, you reduce their hours, and you say, dang it, I'm not going to be able to get full forgiveness because of this. I want to bring them back on at the same pay for the same number of hours as before. And the employee says, no, thank you. I either they're going to stay on unemployment, or they found another opportunity in the meantime while they were on unemployment and they've now started employment elsewhere. Whatever the reason, it doesn't matter. If they reject that offer, you maintain the records, you inform the unemployment office, you do not suffer an FTE reduction because of that. The other exception was if the employee voluntarily resigns. If they say they're out of there, or if they request a reduced hours, again, voluntarily, or if they were fired for cause. And again, you maintain all of the records that state that. Under the old rules, that didn't count as a reduction in FTEs. And in either circumstance, you couldn't have already hired somebody to fill the position, because if somebody left and you already rehired the position, you're at the same FTE spot you were before, you don't get to count the person that's gone. You don't get to add to the count. So that was what it was under the old rule, again, based upon guidance after the CARES Act. Well, under the new rules, we've got basically exception. We've got one new, what we want to call an exclusion, like we talked about before, or exception. And then we've also got a safe harbor. So we've got two new situations where we get sort of a get out of jail free card, so to speak, if we otherwise would have had a reduction in FTEs. So this first one replaces the rule I just told you in the situation where you have let somebody go. So somebody is unemployed, you've let them go. If you try to rehire those individuals who were employed as of February 15th, but you were unable to rehire them, you made a good faith offer, it was rejected, you were unable to hire them, and you were unable to hire similarly qualified employees on or before the end of the year, that doesn't count against you for purposes of the this FTE reduction. And so in the previous slide, we talked about one of the exceptions about the good faith offer. If you reduce your workforce, you lay somebody off, this new rule replaces that. If it's a situation where you just reduce their hours, then that old rule still applies. You just have to make a good faith offer to offer them their old position, same number of hours, same pay. And if they reject that, then that doesn't count against you. The second one, and sorry, I see we've got a couple questions, and I'll get to that here in a second. I'll get through this slide and we'll go through that. In the second situation, now this one's a little bit more interesting and may have a broader application. Again, the devil's going to be in the details with this, as it is for most. But here's the new, what we're calling the new safe harbor. If the business had a reduction in FTEs during the covered period, but the business can document an inability to return to its level of business activity as of February 15th, 2020, i.e. pre-COVID, if they are unable to return to the level of business activity they had pre-COVID by the end of its covered period, so again, by the end of the 8 weeks or the end of the 24 weeks, because they were complying with Health and Human Services, CDC, Centers for Disease Control, or OSHA requirements or guidance related to the maintenance of any worker or customer safety requirement related to COVID. So whether that's sanitation, social distancing, for example, you don't have to worry about any reduction in FTEs. So if your business had a reduction in activity because you were trying to comply with HHS, CDC, and OSHA, and that occurred during your 8 weeks or your 24 weeks, and it caused a reduction in your business activity, then it's a safe harbor in that you don't have to worry about any reduction in FTEs. Now, this is huge. The main question, and I'm just going to leave it at this, is that this only strictly refers to federal mandates via Health and Human Services, CDC, or OSHA. Most of these requirements came from the state and local level. Now, the guidance that we just received within the last 2 hours and 40 minutes does seem to indicate that they will allow this to apply to indirect guidance from CDC, Health and Human Services, and OSHA. So in other words, if you were shut down because of a stay-at-home order at the state or local level, and that was based upon CDC guidance, and again, we need a little bit more clarity on this, it seems that you would fall under this safe harbor provision. So that's the new exceptions for FTE reductions. Now, let me go back. Let me go to these questions really quickly while we have a second before we get too far removed. So first question, if you received a PPP loan, but it wasn't for the full amount of your 2.5 times monthly good cost, can you go back to the bank and ask for an additional second loan up to the full amount? I hate this question because the answer to this question is not a good answer from a client standpoint or from a payment standpoint. No, generally speaking, at a certain point, whenever these loans are reported, up until the point these loans are reported to SBA, and I forget the form number off the top of my head, I don't recall if it's a 1502. Up until that time, you have the ability to amend an application. Once that application is in, though, it's in and you can't go back to the well. And which is unfortunate because there were a lot of people rushed through these on the outset. If this amount was calculated incorrectly based upon the guidance at the time and money was left on the table, in some instances, the amount that was loaned was being limited to the amount that you thought would be forgiven. I know some places limited it based upon that. So if here's the calculation based on 2.5 times your average monthly payroll, but if you could only justify forgiveness based upon some number less than that during the 8-week period, there were some instances where those loans got limited based upon that. And for these loans that you've had for some time now, again, they've already been, the proceeds have been received, the loans have been reported, they've been approved. There's nothing as we sit here today that can be done to go back and make up any gap, unfortunately. So, second question regarding good cost. If you paid part of the company 2019 match, I'm assuming this is retirement match, with your PPP loan, and then you do it, so you paid part of the company 2019 match with your PPP loan during the 8-week period, does that count as a good cost? I think so. Again, if you typically have a history of doing that and the timing is roughly the same, I think you're in really good shape. But again, it's costs that are paid or incurred. So if you decide to pay the company match, which again doesn't have to be paid obviously during calendar year 2019, if you waited till after year end, and pay it during the appropriate time, and it happens to fall within the 8-week period, I think I would, if that makes the difference for you, then great. I think I would go ahead and count that. Here's the issue related to that, though, and here's one of the beauties of this Flexibility Act. We had a lot of questions like that under the 8-week time frame. It's, well, what if we do the match? Can we fund 19 and can we pre-fund 20? What about bonuses? What about this, that, or that? Can we prepay expenses? And so, there were a lot of costs that I would consider to be gray area cost, where we might not have black and white guidance. But if it meant the difference between full forgiveness and partial forgiveness, I think in some of those instances you would count it. Because we've moved from 8 weeks to 24 weeks, the beauty of this is you get to choose which cost you put on the application. So for most businesses, if it's going to require some, let's say, gymnastics to sort of meet the full forgiveness within the 8 weeks, you can always, with the benefit of hindsight, stretch it out to the 24 and then fill that good cost bucket with black and white good cost. Because if your payroll is anywhere close to what it was in 2019, you should easily fill that good cost bucket using the 24 weeks. And so we have fewer concerns related to those type of questions about, we have the opportunity to get full forgiveness using what I would consider to be black and white cost. Great questions, both of those. And again, if we get more guidance on that, there's been some talk about whether or not there needs to be an additional, round of funding for this to allow people to go back if this carries on. I wouldn't rely on that, but definitely as we sit here today, no way to go and bump up the amount of those loans if they were, for whatever reason, underfunded at the outset. All right, so we were talking about fixes. So, again, we have more ways to fix it. In addition, we have a longer period of time. So under under the old rules, if you had a reduction in FTEs or a reduction in wages, and you fixed it, you eliminated that reduction by June 30th, everything was fine. Well, that June 30th date has now been pushed back to December 31st, 2020. So again, you have a longer period of time to make things right. And that applies to every business. Doesn't matter if you're using the 8 weeks or the 24. The only issue is this is one of those areas that still gives us fits. And it may become less relevant given that new safe harbor that we talked about. But all it says is you have to eliminate the reduction or eliminate the deficiency. It doesn't tell you how long. So in other words, if we were at 10 FTEs and went down to 5, and as of December 31st, for example, we bring 5 people back on for that one day. Have we fixed the problem? Or do those people need to be employed for a longer period of time, say at least one whole pay period? If you have a reduction in wages, do you just have to get the hourly wage, for example, back up to where it was just for a moment in time? Or does it have to be for a longer period of time? Do you have to make up the old deficiency? We don't know the answer to those questions yet. All we know is that we have more time to fix the problem. And again, this is one of those areas that we just have not received a lot of guidance on. But again, as we get more of these get out of jail free cards, as I've called them, the safe harbors, some of the stuff may become less relevant. Again, I won't say they will, but they may become a little less relevant. But this is where a lot of the complexity is going to be as it relates to forgiveness. All right, so let's look at the payroll cap. Again, this is one of my favorite things to talk about because there was a lot of misunderstanding related to this. It was not a cliff, even though it was communicated that way. All that the SBA said was that when you apply for forgiveness, at least 75% of the forgiven costs have to be payroll cost. And if they're not, you reduce the amount of forgiven non-payroll cost until mechanically your payroll cost equals 75% of total forgiveness. Not total loan, but total forgiveness. Under the new rules, so that was in guidance. So then Congress said, we want to codify this. We want to put this in the law. So Congress did. And where there wasn't a cliff before, those knuckleheads created a cliff, presumably. Because if you read this very literally, it said you must use 60% of your loan amount on payroll, which then sent us into a frenzy because that was how people misunderstood it. That wasn't what the rule actually was. And so now we were afraid they had created a cliff. Well, Treasury and SBA have issued guidance, and they did some, shall we say, logical gymnastics to, to justify this. But based on that guidance, they've said, we interpret what Congress has written to not be a cliff, and we are interpreting it consistently with the old 75% rule. So as long as at least 60% of your forgiven amount is payroll, you're fine. And if it's not, all it does is it just limits the amount of your forgiveness. It doesn't create a cliff. And so bottom line is we got to the right outcome. Treasury and SBA saved the day where Congress didn't. they might have created a problem where there wasn't one. And so now you have to at least have 60% of your forgiveness associated with payroll cost. And if not, you may just have a limitation, but it's not going to preclude you or exclude you from getting full forgiveness. So because of all this, we knew we were going to need new applications. And so we just received them within the last week. So the old Form 3508, that was a forgiveness application that needs to be revised, and it has been revised as of June 16th. On that date, SBA provided both a revised 3508 to allow for the 24-week period, to allow for that 60% reduction or 60% change. In addition to that, they created a new Form 3508EZ, and we'll talk about that in just a second. And now the problem with all of this is we still have no idea when SBA will begin accepting applications. We have the application, so you can begin putting your applications together, but in talking with the banks, there is still no mechanism for banks to submit this information to SBA as we sit here today on the 23rd of June. So more to come. Now, guidance was issued. This third bullet point may be my favorite because guidance was issued on June 23rd, today, that allows for forgiveness applications to be completed before the end of the covered period. This was news to us because my personal thought was if you chose 24 weeks, you had to wait till the end of the 24-week period to request forgiveness because you were supposed to calculate your FTEs during the entire 24-week period. That guidance that was released now 2 hours and 50 minutes ago states that you can actually apply for forgiveness before the end of the covered period. So that's what I said. That may mitigate some of that risk of stretching your covered period beyond 8. So let's say you fill your bucket with good costs at the end of 10 weeks. And let's say you've maintained full employment. I don't know this with certainty, but it seems to me if your FTEs have not been reduced through the date that you report expenses on your loan application, so say through the end of 10 weeks, it seems to me you shouldn't have to worry. You may not have to worry about reduction in FTEs after that 10th week in my example, but before the end of 24. Again, more to come on that, but that was a new piece of information that we just received this morning. So you don't have to wait till the end of 24 weeks, but we do have some additional questions about how that interacts with the reduction in FTEs and all of those provisions. Finally, and that says 3805, that should be 3508, now has a due date, which for all currently funded businesses is 10 months after the expiration of your covered period, be it the end of 24 weeks or the end of 8. So at the end of that period of time, whichever you've chosen, you have 10 months to apply for forgiveness, a speak now or forever hold your peace sort of deal. So we talked about the 3508EZ. This will make things a lot simpler, but again, they can only be used in very specific circumstances. So if you're a self-employed individual or independent contractor or sole proprietor and you had no employees when you applied for the loan, and you have no employees. In other words, your loan was based upon your 2019 Schedule C or Schedule F income. Your forgiveness is also going to be calculated based upon that same 2019 Schedule C or Schedule F income. So there's no reason to worry about any of this. You didn't have FTEs to worry about reductions. It's a mechanical calculation. You get to use the EZ form. Secondly, if you had no greater than 25% reduction in hourly wages or salaries for any employee during your 8-week or your 24-week period, and you had no FTE reductions from January 1st through the end of the covered period, and I highlighted January 1st because January 1st was never a baseline, but it somehow snuck in on this application, so they've created a new safe harbor, presumably. So if you had no reduction in wages or salaries over 25% and no FTE reductions from the beginning of the year through the end of your 8 weeks or 24 weeks, you can use the EZ application because there's no haircut. Finally, you can use the EZ application if you have no greater than 25% reduction in salaries or wages during the covered period, and you meet that safe harbor number 2, which is the one about unable to return to the same level of business activity due to CDC, HHS, or OSHA guidance. If those situations apply, then you also have no haircuts for FTEs and you have no haircuts for a reduction in wages. And so because of that, you can use the EZ form in the EZ application form. Finally, in the remaining few minutes, there were some other changes in the PPP Flexibility Act that didn't necessarily impact forgiveness, and in some instances didn't directly impact the PPP at all. So for loans after June 5th, so any loans that are written and approved after the effective date of this act, these loans become 5-year loans. Previously, under the old regime, these were 2-year loans. So any amount that's not forgiven becomes a loan with a 2-year maturity at 1% interest. Any amount forgiven on loans after June 5th, any amount not forgiven, becomes a loan with a 5-year maturity at 1%. If you have an existing loan and you have a non-forgiven piece of it, so you actually have a loan and yours was issued prior to June 5th, they do allow you, if at the agreement with the bank, again, you have to sort of refi through the bank, but if you and the bank agree to extend it out to up to 5 years, that is allowed, but they're not doing that just by default. It has to be agreed upon by the borrower and the bank. Finally, there was this concept where I think we talked about it in my April presentation. So all businesses have the ability under the CARES Act to defer payment of employer portion of payroll taxes, of Social Security taxes for 2020 to help with cash flow. Again, it's not an elimination, but businesses can defer payment of employer portion of 2020 Social Security taxes, and those would be due, half of them due at the end of December 2021, half of them due at the end of 2022. The issue with that, though, was as soon as you received approval for PPP forgiveness, you could no longer do that deferral. Under the PPP Flexibility Act, all businesses can take advantage of that payroll tax deferral, regardless of whether you get forgiveness under the PPP. Now, I'll be honest, we have not seen a lot of clients use this. It's only a deferral. If it makes a difference, between life and death from a business standpoint, I think this makes sense to defer. But if you have the ability to make those payments, it just seems easier to go ahead and make those deposits now as opposed to tracking it and then making sure you get the right amounts paid in 2021 and 2022. But just know that that's out there. We haven't seen a lot of businesses that have really gone that direction. So with that, that's what I have as far as my formal presentation. I didn't leave a ton of time. I apologize for questions. We've got a few minutes. We've got links here on this to our website. We have a lot of resources associated with this from the beginning up until current. We've been updating this. A couple of relatively lengthy webinars with slides. Again, honestly, now some of this, though, has become outdated since we've been continuing to refresh this. And in that same vein, we are doing a webinar free of charge this Thursday, 9 a.m. to 10:30, or until we finish answering questions. We will do a live Q&A with that, which is a little bit of a deeper dive associated with some of the more technical aspects. And I know what you're thinking to yourself, holy cow, are there really more technical aspects in this? So, so again, we'll have that webinar. We have those. Again, feel free if you want more information on this. That's Thursday, 9 to 10:30. Appreciate everybody who attended today. If anyone has any questions, again, I'll, happy to answer them now if we have any.
Thank Jeremy. Great job. Thank you very much. A lot of great information, a lot of information. I was thinking the same thing. Holy cow. With the information. Folks, you are welcome to put, if you have questions, type them in the chat box, or if you would like to real quick, you can unmute yourself and ask a question if you like.
And I did not put my contact info on this.
Okay.
But we can provide that. If you send a message to Sean, he can get it to me after the fact. If you go to our website, my bio and contact information is there. It's jmorris, JMORRIS @williamskeepers.com. Feel free to send me an email related to this too if something occurs to you after the fact or you just don't want to ask the question now.
Okay. Jeremy, thank you very much for that. And you've been very, very helpful. I know I keep you referred to going back to the well. I keep doing the same thing with you. So, but you always do a great job and you're on top of it. Even tell me yesterday that there was some additional guidance coming out and you were on top of it. So I will ask once again from the audience if there's any, if you want to unmute or put anything in the chat box, you are welcome to. I don't think we have, Jeremy. Again, we have your contact information. You provided additional resources. We've recorded this. Thank you, Jeremy. We've recorded this, we, the chamber, and we will post this on our website. And you're more than welcome to get, again, thank you, Jeremy, get a hold of Jeremy directly, or if you want to use me as the conduit, you are more than welcome to do so. Jeremy, I do not think we have any additional questions. So what I am going to do is just wrap things up. Any last comments? Jeremy, do you think there'll be there's going to be additional information coming down the pike?
Oh, there has to be, and they've offered it. We're going to continue to get, just like that interim final rule. That's the one thing I learned through this process. I never knew what an interim final rule was until this came down the pipeline. We're going to continue to get that. There are a few things that still need to be ironed out. They've offered us more. We have a lot now, though. That's the good news, is we have enough to make decisions and to act on them. There are a few things we need to get figured out, but yeah, there's still going to be additional stuff. So, sure. You know, I apologize if this becomes old and cold after 5 hours. You know, some big guidance comes out that, you know, invalidates something I said.
Well, that's okay. Again, you're more than on top of it, and we appreciate your expertise. And time today. So, again, thank you, Jeremy. Thank you very much. And what I'll do is I'll just say thank you to everyone that joined us today. Have a great afternoon. Sun is shining outside. You know, we're almost to the middle of the week, so enjoy your weekend leading up to. So with that, I'm just going to say thanks again and have a good day, everyone. Thanks for joining us.